We will focus this episode of the Douglas County Masterclass on drilling deeper into stocks and bonds. We'll look at the factors that influence each aspect of this investment tool and determine which is best for you. When investing, what does it mean to buy a stock? And what does it mean to buy a bond?
Stocks are ownership in a company. Bonds are really ownership of debt. So when a company or some entity needs to raise funds, they'll issue bonds. And they'll say, if you give me $100, then in 5 years, I'll give you that $100 back plus some guaranteed amount of interest.
Having both of these in your portfolio is part of being diversified. Both a stock and a bond are designed to do the same thing, grow your money, but how they do it are very different. First, let's look at buying stock in a company.
The purpose of owning those companies is that you can purchase an item that will give you capital appreciation as that company grows. The company grows, your investment grows. They also pay you a dividend, which is part of their return to their shareholders.
This is good for you, but it has benefits for the company as well.
Companies have to have assets and money to conduct their business. And so part of the way that they fund that is by selling pieces of ownership of the company.
This is a form of equity for you. We will get into debt versus equity in a moment. For bonds, this is issued by a company or government agency to raise money for itself by borrowing your funds.
For a time period, they will pay you a return based on the use of those funds. The difference between that is that particular investment will return that principal back to you. So in a sense, you're basically renting your money to that company, and the rent comes in the form of interest.
Stocks are a form of equity or liquid financial assets, an investment that can easily be converted into cash. Bonds, on the other hand, are debt that will be tied up but must be repaid with interest to you.
Where one provides more principal stability, the other provides capital appreciation and income.
For bonds specifically, you're basically trading off someone holding your money on some fixed term to get a guaranteed rate of return. That's it. With stocks, you're trading off somebody taking your money. And we don't really know when you might take it out. And we don't really know what the return's going to be. So there's inherently more risk because there's more uncertainty.
Keeping both stocks and bonds as part of your investment mix will help you hedge against inflation in the long run. Another difference between the two investments is that stocks and bonds tend to have an inverse relationship in terms of price. Typically, when stock prices rise, bond prices fall, and vice versa. Experts strongly advise you find a professional broker to make these purchases for you, a company or individual that is licensed to make these financial purchases. Make sure that entity is sanctioned by FINRA, the Financial Industry Regulatory Authority. In this episode, we've broken down the pros and cons of stocks and bonds and outlined how it can be a valuable part of your investment strategy. Want to dive a little deeper into financial literacy and improve your financial future? Take part in the free online learning through the University of West Georgia's Center for Economic Education and Financial Literacy.